Okay, Herb Strather here, everyone. Thank you so much for joining us. And we're going to have this webinar on 10 ways to create equity. Now, in this short period of time, I know these are a lot of ideas, but I want to give you the ideal itself and to actually tell you and give you comments on, what are the elements uh, of these ideas. It would be it would be impossible to go through all of the details on every single one because behind these ideas are also purchase agreements, federal requirements, and the like. But we can share with you the ideas themselves. And before I get started, I just want to mention that it's such a blessing to have been born poor. You know, I have mentioned that several cases because being poor with a burning desire, those two ideas combined created in me a burning desire to succeed. And by me not having any equity, by me not having any cash to work with, I was forced to essentially find a way to buy real estate without having cash. And so I think that's where we're going to start with this whole idea as we go through our slideshow. We're going to start from the beginning here. And the first thing is that you got to really believe in yourself. And when I say believe in yourself, believe that you can do it. And you got to start with the idea that that's what you're going to do, buy it without cash. If you if you start with that idea, then you're going to look for properties that meet that criteria. So you have to believe in yourself. Now you're going to need a lot of LLCs. And by the way, our office is in the business of creating LLCs here in Detroit anyway. And we can help you for a very nominal amount. And we'll put the bells and the whistles on it. So make sure that if you want to do this, then let me know. And if you're going to do it in your state, we can discuss with you some of the ideas that we think you should put into the LLCs, which I guarantee you nobody has ever told you because some of these ideas I've created myself. The interesting thing is that these ideals have been created and used by me. It's not like some ideal out of the sky. Every single thing I'm telling you, I've done it at least once. And I believe most of these things I've done dozens of times. Um, so you got to acquire the knowledge that you need, and this takes some time. You sit down, I'll grab something, I'm ready to go. But I've been really studying right now this whole ideal of this online learning because it's so important. And before I jump off and start running, I want to know how to deliver it good to you, how to keep your attention, and to deliver it to the thousands of people who are home all over the United States who now have a chance to retool themselves. And that's the great news. You can retool yourself. Real estate can be a career, or it also can be an investment. And I would like to suggest that it's probably way more stable than the stock market, especially now you know that. But in the long run, because it's a basic necessity, people have to have a real estate place to stay. They don't have to have stocks. So let's get on with the show. You want to acquire the knowledge, and you got to act on this knowledge by running performance. Every deal is not a deal. If you run the numbers and there's potential there, then you know you can structure the deal. Now we went over performers, but we're going to go over them. And these performers are up on our Strather online website. We'll be making them available for all of the students so that you can download these and you can look at them over and over and over. But once you've run the performer and you know you got a deal, now you can move on it. If you found the deal that had the maximum rents, maximum price, and it was a C property, I can tell you that's not a deal. Now, if you had a deal that was a maximum rents, the maximum price, but a Class A property, you probably would have a deal for the simple reason you could probably take that deal and convert it to condos and double the value and do a bargain gift sale. Now, I know I'm getting ahead of myself, but I just want to tell you every deal is not a deal. But for whatever the deal is, the good news is that you have a coach. I will coach you to see that you close the deal. Now, I'm going to put you in a position that I was, not, having a burning desire, seeking the knowledge, getting it, but not having cash. So what you have to do is find a partner with a balance sheet if you do not have one. Now, the good news, we have plenty of balance sheets up around this place, but so we could joint venture with you in various transactions if it merited. But I specifically would like to structure deals for you to become involved in buying your own community. We are going to be rolling out a project later on this year, buying low-income housing tax credit deals, what we call LIHTC, and I'm going to do it with you all as partners. But right now, if you don't have a partner with a balance sheet, then you should work on that relationship. Now let's get started. These are the 10 ways, and we're going to go through them rather straightforward, and then I'll take questions and answers that you might have. Number one, use a purchase agreement with creative. Oops, let's don't get ahead of ourselves. Use a purchase agreement with creative but legal credits. I'm sure lenders are looking and want to know what I'm talking about, because we have to make sure it is compliant. There's such thing as a HUD-1, for example. And there's a title company that's an escrow agent that's going to disperse funds. And nobody's going to do anything that's illegal. And I'm certainly not going to tell you anything that's legal. So the things that I'm telling you are solid ground things, and they're not slick. They're for the benefit of our community. Most urban communities have depressed pricing due to regulatory deals that have been made by the federal government, which is reimbursing banks, for an example, for their losses. In exchange, the bank does not go after homeowners for efficiency. Simply, using a purchase agreement with creative but legal credits is important. Now let's start. Simply include maximum seller credits. The seller can give a buyer a credit up to, I got my phone on, I better cut that thing off. The seller can give the buyer a credit up to 6%. Now, some lenders will not allow such a thing because they may give you a grant or it may be a special program. But normally under FHA program, the seller can give you 6%, up to 6% credit. But be careful about that, because if you say 6% credit and you increase the price to accommodate that 6%, and it's only 3% or 4% actually, because it just doesn't come to 6%, the taxes is not as great, then you will have essentially overpaid by 1 or 2%. So it's not an adjustment downwards after you commit to that, because the seller would agree to anything long as, perhaps, if it's legal, and it doesn't cause him any more tax, as long as he get his net amount. That's what the premises of this is based on. So you include the maximum seller credits, you include improvements, not repairs. Improvements can be done, they're not required by FHA. Repairs are required. The repairs you got to do, but of course you can always do these repairs yourself too, and you can take credit for it. And you know, repairs, you could get 50% upside on repairs. Something that costs $1,000, you may be very well able to do it if you did the labor for $300, $400. Because you know, there's material, there's labor, there's contractor profits. Your contractor said $1,000, then maybe you do it yourself. Now you may paint, for example, and your paint is going to cost you $300, and they're going to charge you $1,000. Now your paint job might not be as good as the contractor, but you could paint yourself, for example. Also, most purchase agreements provide for property tax prorations. You could agree that there is no property tax prorations. And most lenders, I mean, if that's in the contract, that's the contract. You know, it probably will not apply towards the 3 to 6% seller credits, although I believe in Detroit area it's beginning to apply because the lenders watch me very closely. Let's go to the next one. Join an LLC. Be a borrower versus a buyer. Become a member of LLC as of. And there's a retroactive date. Now, what's very important, everyone, is you use the term as of. Because if you said, listen, I'm a buyer as of, I joined in November of last year. Well, you know, and you didn't, then you essentially told a lie. But if you said as of, you could do it as of and get by with it, but not a factual situation. Now's a great time to do this before taxes are filed, because the government have now extended the federal tax return anyway till July 15th, I believe, which means that it gives you a chance to join an LLC retroactive and refinance and cash someone out. And if you fail to do so, gives them enough time to exit you out so you're not on their tax return as of last year. Now, there's a few steps you got to do with that, and we can help you with that. But that's number two. Number three, structure a tax-free joint venture. I love this. Joint ventures can be tax-free. Now, how you form a new LLC, and for all practical purposes, I call those NewCo, a new company, and I'll use that term more than once during my discussion with you, but it's a new LLC. So you form a NewCo, and the seller contributes the property to the NewCo, and they take back a certain interest in this in the NewCo. Plus, they'll take note or a note for cash to be paid upon your refinancing, or cash that you pay, or they may or may not, if it's in a bad shape and they contribute the property, you contribute the construction services and all of that. It may be a 50-50 joint venture. But they will take back the interest plus a note or cash if the buyer will contribute services like a guarantee if there's a mortgage needed, or construction if needed, or property management if needed. And they'll take back an interest, and they each take back an interest based on the value of their contribution. What is the value of the real estate, the net value of the real estate that the seller is contributing, less the cash they're taking back. And then the next step is whatever the parties agree to. Once you all have formed the LLC, you each have contributed your services, you've taken back the interest. What is the basic deal? Is it a new mortgage? Is it a turnaround service? Is it a bargain gift sale transaction? You can take the next step after that. Okay, purchase via a bargain gift sale. Now, this is a highly sophisticated transaction, and you might like to just Google it. Google bargain gift sale and hit it and see what it says. You will find information on it, and it's best to really study it. It's highly sophisticated. I've done more than a dozen transactions like that, and we have some case studies that you can pull up and see exactly what we've done. Now, there's regulatory things that the government insists on. But one is a 501, you have to have a 501c3 corporation with the right purpose. If the 501c3 corporation's purpose is not correct, they can't do it. They may not be able to do the bargain gift sale the way that you want to. I'm doing a bargain gift sale on a property that they're selling for $500,000. The 501c3 is selling for $500,000 less than the amount that they're acquiring it for. How could they do such a thing? They can because their purpose is to facilitate affordable community development. So your purpose got to be very, very specific. Otherwise, they'll say, well, if this was a 70-30 bargain gift sale transaction for $1 million, why are you turning around and selling it for $725,000? What explain that? And if that's not your purpose to facilitate community development, you may put the seller's gift at risk. So you got to have the right purpose. Here again, if you need to create an entity, we're in the entity creating business, and we can help you with that because we've done it a lot of times. And do not try to take an existing 501c3 and convert it, so to speak, to a 501. I mean, do not take an existing nonprofit corporation and try to get a 501c3 exemption on it if it's been around a while, because you got to prove what you've done. You got to prove the minutes, the balance sheets, the tax returns. You got to do a lot of that. Whereas you can start a brand new one and you can get it done under easy forms in 22 days if you know what you're doing. Here again, we can help you, and the students get an inside track to get set up first. That's one of the first things, forming your entities and getting your credit online and all of that. Purchase via a bargain gift. So there are other requirements now once these are structured, but essentially what happens is that the seller, the seller takes a tax write-off for some of it in cash. A good example is a recent deal I did at 15041 Greenfield Avenue in Detroit, The seller had a $650,000 cash offer. I turned around and offered the seller a $720,000 bargain gift sale transaction, where the seller got $640,000 cash and took a write-off for the difference of about $80,000. That worked out really well, and the seller got more money than they would have gotten under the $750,000 with offer. So we were able to actually acquire that and then turn around and sell it. It just so happened we sold it for the full amount, so we did quite well on that. And the buyer is happy too. And if you created a 501c3 that can get control of the property, more than likely the 501c3 does not have cash resources yet. So you're able to, you would be able to bring in a partner, and this partner can help you and with the financial necessities to take to make the deal work. Find yourself a beard, buy from yourself. So what is this about? A beard. I don't have one, you see. So you find a property you want to buy that's selling at a discount. Remember, anything that we talk about have to be, you have to run a pro forma and the numbers got to work. Without that, it's no deal. So you find a partner, a friend, we call it a beard. Excuse me, 1 minute. Madam, trying to talk to people, the noise in the background. I'm sorry, everybody. I just had to just find out. I'm home right now and I'm going to get in trouble. My sister is cooking and she is telling me, I better let her cook. So I hope there's not too much noise in the background. But find a partner or friend, in other words, a beard. Have the beard become the signatory on the NewCo. In other words, they're the signatory. That does not necessarily mean they're the equity owner, or maybe yet they can be the equity owner. You're just going to take most of the profit out of it. You can buy or have another NewCo that you control, buy the property too. You can do it on both ends. One could be the buyer, one could control the property, and one could buy it from the property that you control. You could control both ends of the deal. Isn't that clever? Now, my father used to say, well, the devil is in the details. Well, there are details, and these details I cannot understate it. It is very important. And I've often told members of my class, and I'm telling you, don't try this home alone. Like you can just do it. You got part of it and you go do it and you get in trouble and you say that I told you to do this. No, if I hold your hand A to Z, I will take full responsibility because I know what those requirements are. And if you write up a purchase agreement that says to someone that you're going to get back improvement credits of $20,000 or $30,000, now wouldn't that be a mighty foolish thing? The lender's not going to give you the money. They're going to say, no way, go do a 203 a transaction or something like that. I mean, it's just not going to work. But if you structure the transaction right, of course you can pull it off. Now we'll get into the purchase agreements in our next class and webinar. But for right now, we're introducing you to the ideas that we're going to be teaching over the next 10 weeks on how to finance these properties without having to put up cash. So, you're going to have to get yourself ready mentally, get yourself ready financially, get a partner, and do all of this kind of stuff. If you don't have cash, you're going to have to learn these techniques and understand them very thoroughly. We're going to run the pro forma over and over and over till you understand different performance, which some of you do already because you've been engaged with me. And then we're going to, in these ideas, we're going to say, this is how you do it. And then we're going to take each one of the ideas and we're going to go all the way through it along with all the bells and the whistles. And what I mean by bells and whistles, I mean purchase agreements and regulatory requirements and the like. Now, acquire real estate for equity. Buy or finance for 100% of property. Okay. Buy a property. If you have $10,000, and I've used this example in many cases, if you have $10,000 cash, it's worth $10,000 cash. If you buy a property for $10,000, it's worth whatever the property is worth. And you could use that property for your equity. You could trade it in as a down payment. And some of you online right now listening to me have done that, and that's a good thing. Or are doing that. And as you know, through some of our case studies, many of our students have done that. And you can look at the case studies. And as a matter of fact, we have time. when I finish here, I'm going to run through the case studies really, really quick with you. Okay, PACE, Property Assessed Clean Energy. This is a federal program, by the way, that you could have. And it's not a federal program, it's state by state. It's in 26 different states. It's Property Assessed Clean Energy. What does that mean? It means property that you can finance energy-saving improvements, you know, things that save energy, roofs, HVAC systems, electrical plumbing, the drainage. And you could put the debt, even elevators, and you could put the debt service payments on your taxes. Now you can finance up to about 20 to 25% of the after repair value. Think about it. You got one of these buildings that's been vacant for 20 years, you need roofs, everything, you know. You could go in there. What seller wouldn't sell you the property if you went in there and fixed it up? And that's your equity, and they can give you a land contract for the difference that you can discount off later and refinance and pull cash out. You can use this for equity. Just think about that now. And when you really think about it, your mind is focused on how you can finance property without putting up cash. Think about that all the time. Get out of the frameworks that you don't have the cash. So what? You want the real estate, the equity's in the deal. You can finance the equity. Use that. You're gonna, in this case, you're gonna use your improvements as your equity. You know, I think a big picture is probably important here, and this is what the big picture is. When we say a cap rate, that's what you're buying the property for. That's the rate of return you expect. If a property have $10,000 in cash and you buying it at a 10% cap rate, you're paying $100,000. If you're buying it at a 5% cap rate, you're paying $200,000. Because $10,000, if you want a 5% return, you'll pay $200,000. So the lower the cap rate, the higher the price. Now, you got that, right? In California, Florida, New York, Toronto, you know, the major cities, cap rates are 5%. And debt is around 5%. In other words, your principal and interest is 5 or 6%. So and a lender want to return for every dollar that you pay in a mortgage payment, they want you to have $1.25. So $1, 125% is what we call it. They want you to have $1.25 available for every dollar that you pay. So if you're buying at a 5% and you're financing at a 5%, that's 100%. In order to get to 125%, you're going to have to put money down. You're gonna now if you're financing just 4 points, just 4, you could put 5%. You can finance it if you put 20% down because you're financing 80%. No, but how about if you're in an environment where the actual cap rate is 8% or 9%, and you could borrow at a 5 or 6% debt rate? Well, that is easy. Think about it, 6 versus 9. If you're borrowing at 6 and you're buying at 9, 9 is 150% of 6. The lender only requires 125%. You can borrow and pull cash out. Now, we did a transaction, which I hope I can show you really quickly. If not, we're going to be up in the case studies because I get a little long-winded and I know you're not going to stay with me forever. But here's the transaction: is that if you borrow, if you're going to buy something for $100,000 and the lender, and if you've done your homework and you realize that after you finish it, it's going to be worth 125, 150 grand because the rents are real low. Now, if you tell the lender says, listen, you're buying it for 100, I'm going to loan you 75. So suppose you tell the lender that you want to buy it for, will they loan you the full amount if you put down $25,000? If you put the $25,000 down, and pledge that, put the $25,000 in the bank and pledge that as additional collateral, will the lender loan you the whole thing? Now, what we're suggesting is that you can structure the deal for the higher price, 150, 125, and you can take and borrow the 100, put up the real estate as collateral, plus the CD, the money you borrow, leave it up. They won't know it's the money you borrow because essentially it comes from your fees or something like that. But essentially, you're borrowing the whole thing and leaving it up. I've done that and actually taken cash out at the same time. In other words, I borrowed 110%. So at the end of the day, I have the real estate, I have a certificate of deposit at the bank, and I have some cash in my pocket. And I've done that on more than one occasion. So we can go over that in detail because I know your head is probably swimming. Herb, go over that slowly, blah, blah, blah. And you have got to show that you got the money down because the lender's going to want to know this. They're not going to allow you normally to pull the cash out the transaction and leave up, but that would be ridiculous. They're not going to loan you the money for the down payment, but essentially they did now, but it's your fees and stuff that you can take out. If y'all hear a little bacon in the background, that's my sister cooking really good. I have a sister that is a great cook, and I'm happy about that. Use fees, commissions, consulting, development fees, or construction. Use fees for equity. Now this is self-explanatory, really. If you got a commission, like if you have a CDFI, look that up. CDFI, Community Development Financial Institution. Some of those will loan 90%. I'm just going to keep this as simple as possible. They will loan 90% of the mortgage, especially if it's affordable housing development. So if you have the price to include your credits, you know, your prorations and all of that, and you have a 10% commission, they won't know what your commission is. You're not going to put it in agreement, are you? You're going to say, you know, pursuant to the listing commission or something, and it's secret. Nobody never asks about your fees, at least not till now. I guess the lenders are going to all start asking me now, but in any event, you can take and borrow the whole amount. Just think about it. And then you got, if you're not a broker, you can't not charge commissions, but you may have a friend that's an agent and you can do a deal. They'll carry your water and you give them a fraction of what they otherwise would have because it's your deal. And or you could come to us and we can help make that happen. We're with Realtist all over the United States, and this is an organization that we can co-op with our brothers and sisters to make such things happen. And many of you are Realtists. Development fees could run up to 15%. Construction fees. These things can all be used together. They could be used for bargain gift sales. They could be used for joint ventures. They could be used combined. As a matter of fact, in cases are going to be combined. Finally, there is participating promissory notes. Now, you may not have heard of a participating promissory note, and if you look it up on Google, you won't find it. I understand. I got that. And the reason you're not going to find it is because it's like a creation of ours. I wouldn't say that I created it because I got the idea from someone that had done a deal, and they said, look, instead of you know, you giving me my fee, can I just participate in the deal? And the guy said, well, I need to own 100% of the membership interest. And they said, well, how about if I just had a little participating note? He said, that's pretty cool. So it's a participating note. Now, what is really, really great, you can define the note. You can say it's on all the cash flow, the insurance proceeds, the refinance, the sales proceeds, the condemnation, every fee that comes out, you can say you get a piece of it. You can say you get part of the distributable cash flow or the cash flow, which means that if you get part of the cash flow as opposed to the distributable cash flow, if there's cash flow, you are going to get some. Now, the lender, this is certainly not a threat to the lender, because if you put a second mortgage on a piece of property and they got to pay that second mortgage plus the first mortgage, that second mortgage could threaten their first mortgage. A fixed payment under a promissory note, whether it's on the lien on the property or not, could still be a threat. But a participating promissory note is not a threat. Think about it. It is cash flow if there's cash flow. If there's no cash flow, there's no obligation to pay. It's given in return for a service or a partnership interest. You structure the transaction and you get yours. I've had some where I've gotten the 50% participating interest. As a matter of fact, I've had some that I've got 90% because I got somebody to carry my beard. You carry the beard, you're a property manager, you manage this property and you carry it, and I want 90% of the deal. I'll give you 10% for doing a great job managing it, plus you get a management fee. And I can stay buried if I want to. You know, or I can put this into my daughter's trust, or I can give it to my girlfriend, whatever, you understand what I mean? Now, look, what I'm trying to say to you is that you can take these participating promissory notes, they're 100% passive. They don't have to If it's a 501c3 doing it for an example, it doesn't need a tax write-off. So why would it assume a membership interest and use a depreciable interest when someone else could use it? That's valuable. It has no benefit to a 501c3. It is secured by a pledge of membership interest in an LLC and it's not a lien on the property. Now, was that something? I held my breath during that whole presentation. This is Herb Strather, and I have just presented to you the 10 ways to create equity. Now, some of you might have some questions, and if you do, I will allow you to ask me those questions. And if you don't have a lot of questions right now, Denise or Darren, I'm going to present to you something else. I'm going to share this screen with you. Watch this, you all. I'm going to give you another deal. Let's see what we can do here. Okay, I would suppose that this is up. You can see it. Billy, can you see this new LLC that I've just brought up? I hope. Everybody's still with me. Yes, no, maybe so. I'm going to import this new deal. I hope everybody's with me. Share screen on it.
Press the share screen button again.
Okay, then can you see it?
No.
Okay, I'm going to push the share screen button again if we could do this.
It's not working for some reason.
It's not working. Let me try it one more time. I'm going to go back to Zoom, and then I'm going to push to share the screen. The problem is that it's not coming up. Let me try it one more time. Share screen, and I want the final case study. I don't see where it say. Do you see that, you all? No. Okay. Well, that was a bonus I was going to share with anyone anyway. It's not actually part of what we're doing today. I wanted to just, oh, here it goes. Can you see it now? Darren? Hello?
Yes, yes.
You do see it now. Finding,
yes.
funding, and financing the deal, right?
Yes.
So here's the deal. We have about 10 minutes left, and I want to very quickly go with you through just a deal which some of you have seen before. So finding, funding, and financing the deal. If you don't have the cash right now, you may want to find the deal, pull out cash, and you'll be in great shape. But this demonstrates how you could use real estate and trade it up. And it's also, it demonstrates how you can finance the deal, more fully finance a transaction by giving an assignment of cash in the bank. It has 2 or 3 of the ideas that I've discussed with you all in one. So here's a case study real quick. And we're going to go through this pretty quickly so that I won't keep everybody because I only have a certain amount of time and you all have told me that. So Gary and Hassan, they're 2 students and they are actual real students. And Gary's a black guy, Hassan is an Arab. And they came in together and they were really great friends. And they went blitzing and found an 8-unit apartment building. That's the 8 unit. It's a beautiful building. And it has balconies. It's 900 square feet, including the balconies. And they were only renting for like $550. Go figure, man. It was like a lot of equity in that sucker. So the manager they knocked on the door, the manager let them in, they liked what they saw, and they ran a pro forma. Underline that, they ran a pro forma and said, look at these numbers. These things have great potential. They offered the seller $260. The seller said, yes, go figure. And they agreed because don't forget, based on those rents that the seller had, that's what it was worth. But based on the real rents of $800, $700 rather than $500 and something, it was worth way more. So the seller said, yeah, they agreed they could do the deal creatively, provided the seller got $260 legally and didn't want any taxes, so no funny business. They were happy because they knew they were going to get richer sooner. Now, they talked to me, the coach, over lunch, and I said, okay, let's make a deal. And so here's how the deal went. Another Strather student, her name is Tanya, and her daughter is Kim. And they purchased a house for 20 grand that was in an auction that was worth 70. Now their name's been changed because her name is not actual Tanya, but it starts with a T, and her daughter's name is not actually Kim, but it starts with a K. Let's say that, okay? They Now you could purchase a house or finance a house. Suppose you just financed the house. If you went to the sheriff's sales, and we didn't even talk about that as 10 ways to create equity, there's really 20 ways. Probably, and then there's more than that, but one of the ways is just to go to the auction, structure deal with the seller. If there's a redemption period, like 6 months, and buy it from them, share the proceeds with them. But they got a house worth $20,000. So instead of having $20,000 cash to work with in this case, they had $20,000 in the house. They had cash too, but in this case, they used the house. They reviewed the performer and offered $340. Now, don't forget the seller was going to sell it for $260. They offered $340 with the house as their 20% down payment, $68,000. The bank wanted 20%. I gave them an A. Kim now had 28. She's so cute too. She's a cute little girl. So now, in order not to get the bank all involved in the value of the trade, because the bank want to know, well, this house you got, is there an appraisal? Is there's this? We lined the financing up, but closed the deal early. And then a week later, we went to the bank and said, look, the seller had to close. We're just going to simply refinance, but we'll keep the structure in place, essentially as a acquisition. The seller didn't really care because the appraisal was in. The appraisal was a little late, which gave us an excuse to go ahead and close it because the seller was in a jam, we said, and he was. And then she was already approved. So we went to the bank still as a buyer. Think about it. We went there as a buyer and not a borrower. Remember that concept? Now we went to the bank. It was a credit union, really. Her credit union agreed to finance only 75%, not the 80%. So she walked out. Oh my God, she was not happy. But guess what? I mean, that means they had to put up 17,000 more, 5% of 340. Plus the house. They were sad because they had to put up this extra cash. They wasn't happy about it. I said, Coach, I said, hold it. I said, Kim, talk to me. So here's what happened. Kim and Coach Strather had a great idea. Coach Strather used the house for the 20% down and put up an additional collateral of 17 in cash. That means put 17 in the bank, in the credit union, and pledge it as cash. Now let's extrapolate that. Suppose they brought the whole thing and left all the money up as collateral. Would that have also worked? Probably. Think about it. When the property appreciates, the credit union will release the 17,000. At the time of closing, Tanya's cash back was 23,000. That's actually not true. It was $24,625. And I was going to get that actual closing statement and show everybody so you know. So they closed in February. They're very happy. And what was the moral of the story? To use a performer. And it was so quick, there was 8% cap rates, 8 units, all of our assumptions. And I'll go through this one day quicker, but the rents were 54, the market rents were 67. We ran the performer, and when we ran the performer, the net operating income currently was 20, it was 30,000, the market rate. So they were able to, we looked at what the comps were, and then we did the gross sales price was 340, used the houses, the fees, backed out everything. The net to the seller was 245 after adjustments and the like. And we put it in there all. Don't forget the seller had his closing costs. He had closing costs, he had credits, he had taxes, there was no prorations, he had buyer credits he put in. So at 245, he was happy. It was 260 minus the normal commissions. He didn't care how we did the deal, as long as he did it. So what does this say? Read your home study course, understand how to use Excel, improve your credit score, improve your balance sheet, close the deal for seasoning, and take your day blitzing instead of the movies. So I will say to you now, that is our wrap on our 10 ways to create equity. And I would like to just invite all of you to participate. And I want to make a few other comments about this. We're going to go back to the 10 ways to create equity. We are offering as our service to get started. If you really want to get started, my suggestion to you is to, tell you what, start off with running the performers. And we'll show you how, and we got a special offer for you below. Just look below and we can get you started. In the meantime, are there any questions that anyone have concerning our presentation? Okay, I thank you so very much. And I look forward to,
I have a question.
yes.
So with the PACE, so is it 100% tax deductible?
Is what 100% tax deductible?
With the PACE,
Yeah. Well, tax deductible, no. Improvements are not tax deductible, they're capitalized. Almost all of this would be. Like if you put a roof on it, it is tax deductible over the life of the improvement. It may be 5% a year because it's a capital item. If you put new plumbing in, new electrical, new windows in, those are things are not a tax write-off. They are tax deductible, but they're what we call a capitalized expense, which means it is deducted over the life of the asset. Okay?
Okay.
Thank you very much for that question. Anything else? Denise, anybody have any questions? If you have any questions, we're going to ask that you would just send them to us. You could text them to us. 313-407-4930. Just text them and we'll be happy to give you a response. Thank you so very much.
Hey, Herb, I have a question.
Sure.
This is Darren.
Okay,
Are those 10 methods for creating equity, are they in one of the home study courses or one of the chapters online?
No, no, but we're going to add them. But Darren, you can always have access to this and go over it and over and over because it's in our library. And Billy is creating a library right now, and we have in there a dozen case studies. So if you want to pull one down, any one of these 10, we have a case study on every single one of these transactions. And you can pull them down and you can look at them. But the thing we want you to remember as you're looking is that every single transaction is different. Like the one I just showed you had a little bit of different ingredients from other things. Then another transaction just like this would have different ingredients. It could be a 501c3 involved. It could be a joint venture involved. The seller may want to stay in it. So it's like these are your tools available. And you want to say what tools best resolve this issue. Just put your thinking cap on. This is a thinking game. And as your coach, I want to go back and forth with you and not just get you to buy one property. I want you to be able to think it through. You can always have me, but I'm not going to be here forever either. And at the end of the day, I want to take what's in my head and share with those of you who have a burning desire, especially people like you, Darren, and Denise, and all of you others that are listening, that want to develop the properties in your communities. And our urban communities are critical. I'm an urban community animal, so to speak. Now, that doesn't mean that people who lives in the suburbs, who want to develop the suburbs, these methods would work there also. They'll work in the United States and Canada, in the world, anywhere in the world, in any community, you can use these tools. Just remember that you can look at them, but they're case studies and you need to study them all so that you'll have them in a package. And these are all going to be put up online and available free to all the students that enroll in the course. And we're giving everyone a chance to enroll, and we're going to let everybody start off probably with our performer, and no performance for just probably $99 to see if they want to join us. So, are there any more questions? Well, thank you all very, very much. I do appreciate everyone, and I will see you as usual next Saturday.
All right, thank you, Herb.
All right now, thank you very much. Yes, it is.
Hello, anyone here?